I work with a lot of investor clients, especially our newer investors, or maybe ones that have a couple of properties now. One of the questions I do get most often, in which I refer to you, maybe we could talk a bit about, is whether or not they should be putting these properties into their personal name or having an incorporation.
Yeah, and that's a question that I get asked all the time. And there's a big misconception, I think, why this question kind of comes up is because people always kind of hear that corporations have these low tax rates. So if I buy a corporation buy a property in a corporation, it's going to be way less tax that I'll have to pay, and that's a misconception.
Okay.
That corporations do have low tax rates for active business income. So if you run a business, you do get this 12.5% tax rate, which is lower than most of the personal tax rate, which is why a lot of times people will incorporate when they have their businesses. But when it comes to investments, it's a little bit different. So CRA doesn't want every single person to be able to just set up a corporation and buy assets, especially assets that only benefit themselves, and keep them in a corporation and not pay much tax on it.
Okay.
So what they essentially do is they charge a much higher, one of the higher tax rates in the corporation until you start taking money out of the corporation. So often what will happen is, the way I answer that question for clients is that if they're at the highest tax bracket, they're making more than $200,000 a year, and whether they own it personally or in a corporation, the tax rate they might pay is very similar.
Okay.
So why they might want to incorporate for tax purposes that, you can pay the high tax rate in the corporation, and then eventually when you sell that property and take the money out of the corporation, that can be done at a time maybe when they're retired or their personal income has come down.
Okay.
Because eventually that's the personal tax rate they will end up paying, and the corporation will get some of the money back through refundable taxes. Okay. So investing in a corporation only makes sense if you are at one of the higher tax brackets or if it's for liability issues.
Okay.
Otherwise, a lot of times, having a property that's under your personal name can be useful as well, especially if you're in negative cash flow for any reason. You can help those losses be written up against your other sources of income as well. Versus corporation is, again, its own separate entity. Losses are going to stay within that corporation while you might be making money and having to pay tax on a much higher tax bracket. So it kind of depends. It's one of those accounting answers, like it just depends. But I do think they need to understand that just because you're incorporated, you will not pay a low tax rate.
So is it fair to say that it's a case-by-case situation?
Very much so.
And even within that person's portfolio, it might be the right choice to stay personal for now, and then in 5 years or a couple properties later, a corporation might be the better avenue to take as well.
Exactly.
So to have a constant, active conversation with you makes a lot of sense.
Exactly. That's exactly right.
Yeah.
Maybe I will believe me, woman. It ain't no big deal. Oh, you need love now, just as bad as I do.
Another common question I get with investors is, what can I write off?
Good question. So that, and that's a good question, because even before you buy investment property, you should really be able to manage and figure out what the cash flow will look like from all the income that comes in from that property, as well as all the expenses that you have to pay on that property. So the most common ones that you usually technically see, you're going to write off your property taxes. You're going to write off the insurance for that property, right? You're going to write off any repairs and maintenance. You're going to write off any utilities for that property and so forth.
Mortgage interest.
Yeah, and that's where people kind of get confused. So I was going to bring that up last from the most common deductions, because sometimes people will kind of take that property and say that, hey, if I look at all the expenses that I kind of mentioned, plus my mortgage payments, I'm breaking even on this property.
Yeah.
So I don't need to worry about anything. It's going to eventually build up in equity, and I'll be able to sell it for a massive capital gain.
Yeah.
But from a tax perspective, I think one of the things that people miss out on, that when you pay a mortgage, there's an interest portion to it and a principal portion to it.
Yeah.
So that principal portion is not deductible for tax purposes.
Yes.
Right? So if you're paying, again, $2,000 each month on your mortgage, and $1,000 of it's principal and $1,000 of it's interest, at the end of the year, you'll have $12,000 that you were not able to deduct. Right? And that will show up on your personal tax return.
Yes.
Or your corporate return if you own that property in a corporation.
Yep.
And then all of a sudden, you're paying tax on that $12,000.
Okay.
So depending on the tax bracket that you're in, again, if you're the highest tax bracket, you would pay close to a 50% tax rate. So you see a $6,000 tax bill at the end of the year, which you'll be surprised by. You're like, hey, I was breaking even on this property from a cash perspective.
Yeah.
So why am I paying this tax? So that's where I think you have to understand those expenses really well. But those are the common ones that people should be writing off.
Okay.
And then there's other ones that people sometimes tend to miss out on. A couple of them can be, advertising for your property. So if you have a cottage or a student rental, you might be putting ads up on Kijiji or other Airbnb and things like that. So any cost related to that can be written off, as well as travel expenses as well. So if you manage the property yourself, if you're traveling back and forth to get clean, to collect checks, to collect rent, and things like that. So those expenses can be written off as well. You do have to track those expenses. So if you're driving a personal car for the purposes of managing that property, you need to track what your business kilometers versus your personal kilometers were, and all the expenses that are related to that. So travel ends up being a big one that people miss out on. And then lastly is the capital improvements and stuff as well. So, in a house, and when you own a house, there's always something that goes back into it, whether you're repairing a few things or you're changing a roof altogether, right? So those expenses can also be written off. Again, something to be mindful of, and I always speak to your accountant about it, is the fact that you need to know which one's going to be a capital repair versus an expense, right?
Okay, and what is a capital repair?
Yeah, so the way it is that a capital repair will kind of get added onto the cost of the property, so which basically prolongs the property in any way, or it upgrades the property. Versus a repair and expense is something that you're fixing in the property.
Okay.
So, if there was a hurricane and the roof shingles came off, fixing those shingles and fixing the roof will just be a repair.
Right.
Versus, if you were planning to increase your square footage by adding an extra room to the property, in your garage or above your garage or something of that nature, that, even though it might seem like, again, I was cash flow negative that year because I put so much money towards the house, that is only adding to the cost of the house, not necessarily as an expense.
Okay.
So you will still eventually get to maybe write that off if you depreciate it, but it will definitely help you save from the capital gain perspective when you sell it down the road.
Right, because it's improving the value of your property and you're getting to apply at that point.
Correct. That's right.
Excellent. Thank you.
No problem.
Oh, you need love now, just as bad as I do. Makes me no difference now.
So we talked about, buying properties and selling properties. A lot of times when it comes to investment properties, when people are either buying another one or buying one for themselves, and there's the seller that has a property that's being rented out at the moment, and there's tenants living in there. A lot of times people have questions on how that really works when they're buying a property with a tenant in it. Can you answer and can I explain that process a little bit?
Well, it is complicated, and in recent years it's gotten a little bit more complicated. The LTB and the RTA, Landlord Tenant Board, and the Residential Tenancy Act have a lot of tenant protections, which, rightfully so, should be there to make sure that people aren't being unhoused or that they're being taken advantage of in one way or the other. So when I'm working with buyers who are purchasing a property, obviously the intent of their purchase is really important. Are they looking to have it as an investment property and honor the current tenant that's in place, or are they looking to take it over on their own terms to use for their personal use? We have to make sure that we are always working within the rules and regulations, not just of the buyer and the seller, but of course now we have the added complication of the tenant. So there are documents and things that we can do to issue to either remove the tenants for personal possession, but it does get complicated. And I think the most problematic part of it is that when people write an agreement of purchase and sale, sometimes agents or clients will make the assumption that tenants will leave, and they won't. So it's just really preparing your buyers that if you're purchasing a property, there may be a tenant implication if they don't leave on closing and what that looks like. One of the most common questions is, well, can't you just ask the seller to guarantee vacant possession? Well, that again can be complicated, because if the tenant doesn't have to leave and they are able to go exercise their rights through an application to the LTB, that can sometimes be problematic based on a firm closing date. So if the seller is promising that, then you would need a revolving closing date in order to make sure that continually gets extended until they remove. Or if they do that and they don't leave, then the seller is at risk of breach, because they're unable to promise the terms in which they were agreed upon. So I think, being super clear about tenant rights and potential issues that can come up when you're purchasing a property or even selling a property. Your real estate agent it has to be really, really, really clear on what you can say in an agreement of purchase and sale and what you can't say. And then, of course, making sure that when you're serving notices to tenants, that the realtors know what they are allowed to do, what they're not allowed to do, because sometimes that can jeopardize the entire process too, and then you're back to square one. There are a lot of great tenants and also sales of property where the tenants do move on, and it's no big deal. But there are some key issues that do come up fairly commonly. So it's important to have a professional who understands that dynamic for sure.
Right. And I think the biggest thing you said is don't assume, always ask the question,
Yeah.
have your real estate agent be diligent enough to work for you
Yeah.
and answer those questions for you and bring you clarity to that situation.
Exactly. Are they familiar with the landlord tenant board? If they go, what's that?
Right.
Or, the RTA, what's that? It's your clue.
Right.
Another really great indicator too is, do they have rental properties themselves?
Right.
If they do, they probably have a vast knowledge of what that looks like and how that can be.
It's first-hand experience, right? So.
Yeah, exactly. And it doesn't mean that if they don't have investment properties that they don't know what they're talking about. But it is something that gives a lot of added value if that is something you're coming across as a buyer and or a seller.
Good point. Yeah. Yeah. Awesome.
It ain't no big deal. Oh, you need love now, just as bad as I do. Makes me no difference now. Oh, you think your thing too? Oh, it's your thing. Do what you gonna do. Say, I can't say, but I shock you too.